Well, for starters, the Nifty suggesting we're likely to see a big pullback. It's going to be tempting for the bulls after the kind of run that we've seen. Will we see a recovery from those lows? Or are we bracing for a bit of a downtrend day where we keep moving lower? Like what happened in the US markets, they ended at the low point of the day. We'll wait by for that for the time being. Let's continue our conversation we're having with Nishal Maheshwari. Well, Nishal, some of these auto stocks, they have been looking good. The problem is some of them have run ahead of themselves. Now, today you're going to get a pullback on most of the listed companies. What's your take? Will any of them provide a good buying opportunity?
Yeah, I think auto continues to do well, and we are just at the start of a festive season, so we expect strong recovery to happen. Economy also is doing well, so I think our preference remains to be CV out there, so Ashok Leyland and Tata Motors. And then the four-wheelers where we have only a limited choice. So I would prefer actually M&M, which is more of a tractor company, but doing well on the SUV side over Maruti. And then the third choice is two-wheelers, basically. So that is the pecking order which I have basically as far as autos is concerned.
Okay, anything in the auto ancillary space that you like? Because over there as well, a lot of these companies have been doing well. Not the guys who are focused on the export market, but more domestic based?
Not particularly, basically, but I think tire companies start showing value out there. So I think one should look at tires and batteries. Those are the two sectors basically which have not really done well, but with the recovery happening in the sector, the consuming sector, basically, I think those two sectors should be looked at closely.
Tires have been doing very well because of the fall that we've seen both in crude as well as rubber prices. It's almost a 50% gain that Apollo Tyres has seen in just 3 months. Thanks, Nishal, for joining in. Let's go across to Chandan Taparia now, who is the derivative and technical analyst at Motilal Oswal. Chandan, good morning. What are your stock ideas for the day?
Good morning, Sonia. So first of all, we were seeing good momentum in the market. Nifty headed to 18,088 marks. But today, in line with the weakness in the global market, we are opening down. So we need to closely watch the key support of 17,777. Earlier it used to work as a hurdle, and recently it has surpassed, so momentum continued to us 300 points higher from the same. So we are opening down. Now again we need to respect the 17,777. If that is respected, then again buy on decline stance could continue in the market with major positional support of 17,442 level. So now looking at trading ideas, first is buy on Siemens. See, first of all, we are expecting volatility to spike up as we are opening down and negating the higher lows of last 3-4 trading session in the index. But decline could be bought in the counter, which have seen the good breakout, and now role reversal pattern may be placed after retesting the breakout zone. So first is buy on Siemens. Buy on decline is clearly visible here. Consolidation breakout has seen, and stock is trading at lifetime high territory. We have seen good rollover, and now longs are being built. So decline could be bought with support of 2950. And here we are expecting a move to us 3200 to 3250 level. Second trading idea, that is buy on Bharti Airtel. Measure trend is positive. The stock is making higher highs, higher lows. Rounding formation is clearly visible on the weekly chart. So decline could be again bought here with support of 760. And here we have a target to us 810 to 815 level. Last trading idea, that is on the sell side, is sell on Torrent Power. This stock is making lower highs, lower lows, falling down from last 4 trading sessions. Shorts are being built. And we have seen negative crossover in mechanical indicators. So because of that, 3 to 5% weakness could be seen in the counter. So recommending to sell on Torrent Power with a stop loss of 565. And here we have a downside target towards 535 levels.
All right, Chandan, thanks a lot for joining in and have a great day. That's Motilal Oswal Financial Services. But let's move on. Ami Organics is a stock on our radar. There was a large block trade where the promoters have sold 0.8% of total equity, or 2% of their own holdings. The buyers are Plutus Wealth Management and Small Cap World Fund. To remind you, the promoters had also sold 60 lakh shares in the IPO when the stake came down to 41% from 47%. Naresh Patel, who's the Executive Chairman and Managing Director at Ami Organics, joins us now. Naresh, good morning and thanks for joining in. Can you explain to us the rationale behind the promoters selling stake, and will there be more stake sales coming through from the promoters' end?
Good morning, Sonia. First of all, I would like to say thank you. And today is our first anniversary day of listing. Coming to your question related to the promoter sales, since inception in 2004, Ami Organics promoter has not done any liquidations. Even in fact in IPO also, major liquidation was made by one of the long-term investors, Chotia family. And this is the first time promoter has done very minute shares for need of the family, whereas this is the one time only. On longer term, we are not planning to do any dilutions or any sales in future.
Nothing at all, Naresh, in terms of no more stake sale. I mean, that's you're telling us in black and white.
Yep. Yes.
At least for the foreseeable future, of course. Got that. And congratulations on the 1 year anniversary, as you said. You know, the investors who've bought, they're reputed investors as well. So that gives some confidence as far as your other shareholders are concerned. So let's move on. Could you tell us how you've got exposure to Europe, right? France, Italy, etc., as your export markets. I mean, when we talk Europe, what we see is usually pretty dire, the situation there, because of the energy crisis and things like that. Any impact whatsoever because of what we are seeing there on your export revenues?
See, you are right. This is current geopolitical and gas crisis in Europe is making a major concern for several industries, mainly the industries which are consuming more energies. Whereas our main customers and market is in pharma, which is essential sector, where I don't see there will be immediate impact on, because it's a very essential requirement for the industry, as well as whatever we have discussions with our current customers and all, they are all expecting not to have any near future impact on the supply, demand and all. So we have also very good orders in hand. So that will also prove us that we don't find a very near future having any impact on our supply to the Europe.
All right. Hi, Naresh. Morning. You know, I wanted to ask you about this electrolyte additive facility. That's the big trigger, I think, from a stock perspective. Could you tell us when you expect to commercialize this? Will there be some kind of revenues that will come in, say, in the end of FY23, or will it be in FY24? What kind of a revenue number you're looking at only from this segment? Because this is going to be the big trigger, 24, 25. What is the outlook out here?
Thank you. Basically, when we developed this electrolyte as against China, we are the first company who had done this electrolyte additives, which is considered as an ACI in the solution of electrolyte and lithium battery cells. But when we were not expecting it was moving a little bit faster than what we had planned. Currently, we were expecting to sell only in China, but recently we have got huge demand from Europe, from other countries in Asia, in fact in India as well. So we are expecting that we will be finished our qualification by end of this year, and by Q4 we may get some commercial orders, which will be very optimistic. But yes, it is moving very fast qualification, so we may get it that. Particularly only for the business related from electrolytes. It's a very big business and it's a fast moving sectors. We are targeting to cater in our product segments somewhere around 5 to 10% of the total market size currently.
And what is the market size? What is the market size?
As per the reports and all, it will be a very huge market, more somewhere around $1 billion to $1.5 billion in current market situation.
And when do you get to this 5% of market share?
It will be a longer journey, but this is our target for near future, 2 to 3 years.
Okay, 2 to 3 years. All right. All the best for that. So this is about the electrolyte segment, but also talking overall, it's been quite a decent growth that you've seen, a 16% revenue growth in Q1. What kind of average growth are you looking at for the full year, and what kind of margin band can you eke out?
See, normally, historically, if you say last 10, 12 years, we are growing at a CAGR of 20%, and which will be, we are looking in this year as well, the same 20 to 23 to 25% growth in this year as well. And it's also showing in our current business profile and current orders in hand. It's a very achievable, which we are looking in that. Related to margin, after acquiring Gujarat Organics, our consolidated margin is little bit on a downside, but and also some export freight forwarding and energy cost also making some impact on that. But it will be remaining. Last quarter was remaining flattish against the Q4 of FY22, and that will be going to be improved every quarter by 1 or 2% basis going on.
Sure. So this 23 to 25% growth that you're targeting for the full year on the top line, will there be any new value-added products that you're launching, and would that add to your revenue stream, at least in the next 1 to 2 years?
AMI Organics' DNA is to develop very early all the intermediates which is going to be expiring next 10 years to us. We have a more than 380 product pipeline which is having expiry up to 2035 with also qualified at the customer end with the secure customer base as well. So every year we have 5 to 10 products which are introducing in the basket which are expiring next in every year, and that gives the driving growth of the business of the AMI Organics.
Well, Naresh, very quickly, electrolyte additives business, you said you want 5%, the market size is around 1.5 billion odd. So you mean nearly around 500 crores could come in from this side of the business in the next 3 years, which will be massive on the current base that you have.
Yeah, that's true. But this is all, see, normally whenever we say that electrolyte business is not our part of the projections and growth, but this is a new thing which is a very emerging market, and we are focusing very strongly on that. We are planning ourselves to be remain available for supply chain, because current geopolitical China's position is that all the mostly the electrolyte cells manufacturers are shifting from China to Europe and other countries, and this is giving us a good advantage to grab that opportunity, and that is how we are targeting to grab this opportunity, which is very and we are the first one who had produced the battery grade electrolyte additives outside China, so that will give us a good advantage.
So you're saying that overall what's happening in Europe, you have exposure to France, Italy, etc. What's happening in Europe with the energy crisis, that's not impacting your business in any way, or the demand in any way?
No, I'm not saying that it is not impacting, but it is going to be if it is start impacting, it will be the last to our business segment, because we are mainly in pharma. So it is a very essential requirement for the human being. So that's why we don't foresee that it will be immediate impact on our current business demand.
All right. Thanks very much, Naresh. An analyst compared at least the business model to Divi's business model. But that's high praise. So you're in a good position, good place. Thanks very much for joining us with that perspective. Thanks indeed. Well, that's the management of AMI Organics. Just 4 minutes to go for the market open. We are going to be starting lower, but time for 9-10 calls. Sudarshan is back with us. Sudarshan, what do you have?
Well, today is a day when I want to avoid trading the indices. There is too much volatility, and I have already explained the same applies to stocks for people who are looking for a buy on dips opportunity and accumulate. ICICI Bank and L&T are worth buying for the long term.
Mitesh, what about you?
Yeah, I will choose a sell on Coromandel with the stop at 1,048 for targets of 1,005.
All right. Thanks very much, both of you, and we'll come back in a bit from now. Now, time for standout brokerage reports. Nimesh, of course, scans the landscape, and he comes up with what should be stock moving and market impactful. Nimesh, over to you.
Hi, Prashant. Today's standout is on the IT names, and coincidentally, on a day when Nasdaq was down 5% last night, Goldman Sachs has gone ahead and downgraded the top Indian IT names, largely on back of still high valuations. And they're not factoring in the down cycle ahead. So they've downgraded TCS, Infosys and Tech Mahindra to sell from buy, and the only upgrade is to Wipro to buy from earlier sell. Now they believe that the US dollar revenue growth will start to materially slow down from here. So Goldman Sachs has cut the dollar revenue forecast of the top 5 Indian companies by 4% to 6% now versus their earlier estimate of 10%. I mean, all this within this backdrop, they believe that the PE multiples are still very high and not sustainable. So, coming to individual names, on Infosys, they've downgraded the stock to sell now from buy. They've cut the target price sharply to 12.24 versus the earlier target price of 17.22. They've also cut the EPS estimates between FY23 and FY26 by 6%. On TCS, they've downgraded to sell now. They've cut the target price sharply there to 2611 versus the earlier target price of 3678. Even for TCS, they've cut the FY23, FY26 EPS estimates by 5%. On Tech Mahindra, again, downgrade to sell, but they had a neutral earlier, and they've got the target price of 686. The only change is Wipro, where they have upgraded the stock to a buy from sell Again, the target pressure is 381. The upgrade on Wipro is purely on valuations. Otherwise, even on Wipro, they've cut marginally. They've cut the EPS as well. The big thing is they've downgraded the top 3 Indian IT names today to sell from buy, and they've sharply cut the target price and the EPS estimates as well.
All right, thanks a lot for that, Nimesh. Well, we're looking at Ambuja Cements as well. Next couple of days is going to be a board meeting. They're looking at fundraising. We'll have to see which kind of instruments they're looking, whether it's going to be debt, equity, or mix of that. The street will be waiting by to know what they want to do with this money. They're already sitting on cash of close to around $1.5 billion odd. So what do they want to do? Is it going to be organic, inorganic growth odd? So keep an eye out on the stock for the next couple of days. Well, things are likely to shape up with regard to what they want to do and their plans. But I think we're in time for market open.
That was some rapid fire. You still had 15 seconds left. You could have taken your breath. But yes, okay, Ambuja Cements in focus. All right, but market opening is going to be quite a steep sell-off. I mean, in line with what the SGX was suggesting, of course. The Nifty down almost about 300 points. The first tick coming through, and as we were predicting, the Nifty is now down 280 points. The Sensex is down 960 points, so quite an ugly opening. It's IT all the way. Tech Mahindra, Infosys, TCS, Wipro, HCL Tech are your top losers right now, down about 2 to 4 odd %. And then you have some of these companies that have an exposure to global markets. Tata Motors is down 1.5 odd %. Tata Steel is down about 1% or so. Reliance Industries is down about 1.5%, dragging the market. So it's a secular move on the downside that we're seeing. Very few and far between. Only Asian Paints is holding up in the green. Otherwise, most Nifty components are in the red, with steep losses seen in the in the IT stocks. And of course, the market breadth is on the weaker side as well.
Oh, absolutely. It is. And looking pretty weak and down and out, as it would on a day like today. What do we have on the downside? It's all tech, actually, as Sonia pointed out. Infosys, TCS, TechM, HCL Tech, LTI, Wipro, L&T Technology Services, Mindtree, Coforge, Persistent. Oh, boy. I mean, I think the top 7, 8 volume-led losers are all actually more. I mean, if you want to count Naukri, there is KPIT, Policy Bazaar. Policy Bazaar, of course, was up some 11-12%. Birlasoft, Emphasis. Actually, the top 10, 11 volume-led losers are all IT. Losses in between 3 to 5%. And LTI is the top loser. No, actually, both LTI and LTTS both are down 4.5-5% each as far as the opening goes. So that's where the bulk of the pressure is. I think the market's coming back up a little bit. We've recovered a little bit on the Nifty. We are down 1% now. So, yeah, I mean, the low right at the open was about 17,771, and we are at about 17,873. So there's a 100-point bounce, which is already underway right after the opening at this point in time. So we'll see. The gap down, from the gap down, a full 100-point bounce is what we have had at this point. Broader markets, let me just see some gainers. Ambuja Cement, Nigel was talking about that, 1.25 higher. PVR is up about 1%. ACC is up 0.5% or so. Asian Paints is up a little bit. And there is KEC International, which is up about 4%. Ami Organics, we were just talking to the management. That starts about 3% higher, 1,140 on that name. Nigel.
Well, just take a look at Ambuja Cements. That one has done pretty well right off the bat. The stock got bought into. So good bounce is what you've seen on that one. The other stocks that are really in focus this morning, you have ACC as well that's moving in tandem. If, the group is planning on doing some inorganic growth or some aggression out there, well, ACC as well has got bought from the low point of the day. PVR is the other one that's up close to around 1%. Remember, Friday's trading session got knocked back, but that's pulling back a goodish bit. Mid-cap IT stocks, they're coming for some selling today. DCB Bank as well is under some pressure. But Ami Organics, that's clearly the stock. That's bounced up close to around 2.5%, building onto yesterday's big surge that we got. So the promoter selling some stake, but a bigger name coming in there and buying stake. It appears the street is appearing pretty confident on that. It's up close to around 2.5%. On the index, a quick point out there, the Nifty Bank, that as well has seen a close to around 250 to 300 point recovery from the low point of the day. The first dip got bought into, as we suggested earlier today as well. Risk reward was favorable out there. But the first hour low is something that you should track. The 20 DMA comes in at around 17,700, and it's going to be crucial to see whether or not this pullback can sustain for the remaining of the trading session. Prashant.
All right, so that's the opening. I mean, the first couple of minutes of the open as things stand right now. Our market master of the day is with us. Saurabh Mukherjee, as founder at Marcellus Investment Managers, is joining us to take some questions. Saurabh, great to have you with us here on the program as always. Thanks very much. What have you been doing, Saurabh, at Marcellus in terms of stock picking, buying, selling over the last many weeks? The markets rallied on significantly to within 3% of all-time highs, despite the 200-point dip that we have at start this morning.
Look, Prashant, as you know, we don't do that much buying and selling. I mean, in a given year, I think in an entire year, we probably buy 2 or 3 stocks across our 4 portfolios. And in an entire year, we sell 2 to 3 stocks across our portfolios. So the 13,500 crores that we look after is broadly spread across 32 stocks. And that number has stayed constant over the last 3 years or so. So we don't really lose that much sleep about in these inflation rates and which broker is saying what buy, what is a buy or what is a sell. Our view remains, as it has for several years, that this country's economy is in reasonably good shape. We are formalizing the country. As we formalize the country, the black economy is getting crunched and well-run companies benefiting from that. So that continues to be the case. So we've bought one more stock in Little Champs, but I think the position building is continuing. So it's a healthcare related play based in South India. Once the position building is done, I'll be happy to tell you more about that. We've also bought ICICI Bank over the last 3 or 4 months. We've gradually built a reasonably good position in ICICI Bank. And the sorts of IT stocks that you're showing on the screen, TCS remains one of our largest holdings there, and we don't really have any compunctions. Honestly, anybody who worries about just watching this stuff, your action on the screen, anybody who sells IT stocks today is like someone shorting steam engines in the heart of the Industrial Revolution, which is why we don't lose too much sleep about this. Just one disclaimer, everything I'm talking about, Marcellus owns these stocks in large volumes. I'm an investor in Marcellus's PMSs, so are my parents, and therefore I have a vested interest in these companies.
Okay, fair enough. Well, the market, the Nifty headline index is still under pressure, down about 200 points. But there's plenty of buying action in a lot of the cement names. Of course, ACC, Ambuja are your top gainers right now. And the consumption basket, whether it's Pidilite, something like the auto stocks, Bajaj Auto, TVS, Ashok Leyland are all holding up in the green. PVR, of course, has been a big gainer ever since the Brahmastra blockbuster. And then, a couple of these other domestic consumption pieces, Marico, etc., are bucking the trend today. Saurabh, hi, good morning. Before I move forward, you said that you have TCS as one of your core holdings in the portfolio. IT companies have given you a good opportunity now, right? I mean, most of them are down 20-30%. For someone who perhaps missed out on the earlier bull run in ITs, is it a good time to buy, or you just hold on to what you have and don't add on to these large cap names? What's the advice?
Well, let's look at it in 2 levels. Whoever is building a sensible, high-quality Indian portfolio out there, you have to have Indian IT in it. It's one of those sectors, one of the rare sectors where we have world-class companies which are in the top 2, top 3 in the world. Secondly, as I said, we are in the era of technology. If you don't have an IT company, it's like having a portfolio in the Industrial Revolution which doesn't have steam engine technology. So have IT services to play the ongoing technology revolution the world over. In that context, to our mind, the Indian IT services company with the strongest competitive advantages is TCS, right? By a country mile, we think there's clear daylight between TCS and the rest of the IT peers, especially on supply side, how they recruit, how they train, how they have the highest operating margins in spite of not overpaying, the lowest attrition rates. And whatever are short-term concerns which are leading people to do the sort of selling that I'm seeing on your screen, we honestly don't lose too much sleep on that. We know the company's strengths. We know that they've built a great franchise over 40 years, and we carry on buying these stocks and holding them for 8-9 years.
Hi, Saurabh. Morning. What about the tier 2 names from the banking space? You indicated ICICI Bank, and that's really been a big outperformer. But what about the tier 2 banks, some of those mid-sized banking names? There's hope of consolidation, hope of things improving from a year on, valuation support. You stick to the larger names, and similar the case with the other pillar of the market, the IT names. Mid-cap IT, are you interested out there?
So hope is not an investment strategy last time, So you can't hope to invest in a bank which doesn't deliver an ROE above 15% and hope to make money, right? If you don't deliver ROEs above 15% as a lender, it's very difficult to build shareholder value. You just struggle to stay afloat, and then one day when a COVID type instance or an economic downturn comes, you're blown out of the water. So we don't have second tier banks in our portfolio. We have HDFC Bank, Kotak Bank in consistent compounders, and in Kings of Capital we also have Axis Bank and ICICI Bank. Vis-a-vis mid-tier IT, we struggle to understand the business case for mid-tier IT companies, because mid-tier IT companies tend to be vertical specific, and then you and I are left second guessing which vertical will thrive at what time, and unfortunately none of us in Marcellus have that sort of prescience. A firm like TCS covers the waterfront, but most importantly, a firm like TCS has very strong supply side advantages, which mid-tier IT firms don't. And this is an important point. Mid-tier IT firms don't have supply side advantages on the recruitment training side, and hence we steer clear of them. We have LTTS, L&T Technology Services, which is an engineering R&D company. We have that in the portfolio. As you would have heard, there's a massive shortage in the West of people who work in engineering generally and in engineering R&D specifically. And we think LTTS is a beneficiary of that. They too have meaningful supply side strengths in terms of getting engineering talent from the engineering colleges in India.
I like that analogy. It's like shorting steam engines in the heart of the industrial revolution. Well, Saurabh, tell us a little bit about what, you guys in the team at Marcellus meets companies, and there are so many conferences going on, and I don't know if you participate or having management meetings, etc. What's the overall feedback? What are companies themselves feeling about their own earnings prospects and how growth is going to pan out over the next year, 2 years? What's the mood like, really?
Look, I've been in India now for 14 years. I haven't seen the promoter community as pulled up as they are at the moment. There's a variety of reasons for it. I think cost of capital, generally cost of capital in India, debt, equity, whatever you want to take. Cost of capital is at least a 20-year low. I haven't seen Indian companies enjoy this sort of low cost capital in spite of the Federal Reserve rate hikes. Cost of capital for well-run companies remains extremely low. Secondly, the banking system, the heart of an economy is the banking system, is in great shape, and that's pumping capital into various parts of the ecosystem. The tier one capital for the banking system is good. Stressed assets are low, and the fact that the banks are willing and able to finance the economy is giving people a lot of confidence. And thirdly, as is increasingly evident by the passing week, China is in the midst of a full-blown economic implosion, and that's creating a variety of opportunities. So honestly, the biggest challenge for us in some of our investee companies is this entire sector. So for example, specialty chemicals, pharma, API, there is so much demand coming through that these guys are struggling to stay in India. They're running around the world, especially Europe at the moment, signing up demand. So I think there's a alive and awake sort of sentiment. The Indian promoters saying, I'm alive and awake to opportunities which are arising as China goes through a full-scale economic implosion. So if the question is promoter sentiment good or bad, it's incredibly positive. Is there a forward-looking indication for how well the country and companies will do? I think it is. CapEx, FY22 CapEx, now that the annual reports are out, we can see FY22 CapEx was twice as high as the preceding 3 years, which gives you a good sense of how much money these companies are putting to work.
Okay, by the way, the market has cut its losses quite a bit. In fact, there's buying on dips and serious buying at lower levels. The Nifty low was 17,770 and now we're back above 17,900. So, the tape is similar to what we've seen for the last many days. Whenever there's a gap down opening, the dips get bought. A space that I wanted to ask you about, Saurabh, is defense. Because anything and everything is rallying here. And yes, the government is, doing a big push in this space. But not just some of the larger guys like BEML, BELs of the world, but even some of these ancillary beneficiaries, right? Whether it's data patterns, MTAR Tech, we were speaking to the management, Paras Defense, something like a Taneja Aerospace. Now, a lot of these companies have balance sheet issues as well. They have other issues like promoters selling stake. So I just wanted to sift the wheat from the chaff. And can you tell us which are the companies where there are long-term opportunities for retail investors, something perhaps you may or may not have bought currently, but you see some potential in the future?
Sorry to disappoint you, Sonia. We haven't found anything worth looking at in this space. I think part of the challenge is working capital, right? These poor guys, they do all this work. By the time they get paid, they're almost bankrupt. So it's a huge challenge, I reckon, for the defense ecosystem, right? The procurement cycle is prolonged. So you do research, you participate in God knows how many trials before you actually get the contract. Then you build the stuff, then you get paid. And that entire cycle just exhausts companies. Most of these companies, as that you're suggesting, and the names you guys are flashing up, these are relatively small companies, right? I've met them over the years. A lot of admiration for the amount of hard work they put in putting essential technology together. But it's really, really difficult to make money because of the prolonged procurement cycle and then the delays in getting paid.
Well, Saurabh, final question then from my end. I want to ask you about the pharma stocks. I think you've been a believer in Divi's. The management has been sounding a little skittish on the margin parameter for a whole host of issues, and I listened into the last con call a lot. You continue to believe in this story? That's Divi's. It's been part of your portfolio, I think, for a while. And any other pharma name?
China is in the midst of a full-blown implosion. China is the world's largest manufacturer of APIs, right? As the entire pharma chain as the entire global pharma supply chain reorients, right? APIs into API -1, intermediates, key starting materials. As their entire global supply chain reorients, it'll be astonishing if Divi's does not make lots of money out of that reorientation. I can't give you more specifics than that, but our reckoning is there's lots of money to be made here, and we continue loading up on this stock as we've done over the last 4 years.
Just one quick. I know you don't. You're not very much for geopolitics and things like that. But since this, you are a believer of the fact that China is imploding, and that does. It's such a large. It's a fact. It was the factory of the world, still is. And if there is a shift to other low-cost, very efficient manufacturing hubs like India, it can. I mean, one can become a hub. We are not one, but we are in the process of becoming that. How much of this entire, some believe that China is shooting itself in the foot. Is that really, that downward spiral really likely to continue? I mean, there are elections there in October, and once President Xi gets a third term and maybe, as some believe, becomes president for life, will they turn the tide? I mean, how much of this some of these investment thesis built on China continuing to implode? Saurabh, your sense?
Look, I mean, Prashant, I honestly don't know anything useful about Chinese politics. I know what you're getting at, and I read the same newspapers as everybody else, but I don't know anything useful about Chinese politics. What we can see, Prashant, is the financial data, say on, you log on to various financial data provider websites that we subscribe to, and the data is devastating. The data suggests that even the best Chinese companies, the sort of Chinese equivalents of HDFC Bank or Asian Paints or Pidilite, even the best Chinese companies haven't given foreign investors meaningful returns over the last 10 years, 20 years, 30 years. And as a result, what we can see is foreign capital is saying, we're fed up of this country. Foreigners have invested the best part of $4 trillion in the Chinese stock market. They haven't had much to write home about. In addition, you've had these events like Jack Ma's very public defenestration by the Communist Party. That's obviously unnerving investors, that if someone as capable as Jack Ma is taken to task for the comments he made, I think 2 or 3 years ago, then what happens to lesser Chinese entrepreneurs? So from a FII perspective, I think it is but inevitable there'll be a massive shift out of China. Even if you assume $1 trillion goes out of China and half of that it comes to India, Prashant, half of that comes to India over the next 3 years, that'll almost increase FII investment in India by 70%. So that's the scale of what's happening here. 10, 20, 30 years of poor financial performance by star Chinese companies has left foreigners disappointed and their economy in poor shape. Leaving aside the politics, there's that economic unraveling, I think, is the bigger opportunity for India.
Okay, economic unraveling. Yes, a lot of things are improving for India, right? I mean, inflation is under control, up until now at least. Growth is picking up, corporate profitability is picking up. and the PMI data has been looking good as well. So, well, a lot of things are coming in India's favor. Let's see whether we can continue to weather this global storm. Saurabh, thanks a lot for joining in and have a great day. That's the word coming in from Marcellus, speaking on sectors and the market, which, by the way, has recovered quite a bit from the lows. We're still down about 140 points, but not as bad as when we started off trade, and the Bank Nifty has completely cut its losses. So now the Bank Nifty is barely down about 0.2%. A piece. Even the Midcap index is seeing a lot of buying interest. Well, let's do one thing. Let's move on now. Crompton Greaves Consumer Electricals is the company on our radar. There has been a key management change. Kaleeswaran Arunachalam has taken over as the new CFO. He joins in for his first interview. Remember, he is the former global CFO of Eicher Motors, so he comes in with a lot of expertise, and he has headed many consumer companies in the past as well. Mr. Arunachalam, thanks a lot for joining in. I never got a chance to speak to you while you were CFO at Eicher, so good at least to speak to you now in your new position. Tell us, what do you plan to bring to the table? You have a lot of consumer experience. What does the way forward look like for Crompton?
Good morning, and it's a great pleasure to be part of this session. To start with, I think my career has moved around slightly away from the traditional route of a CFO. Quite early in the days when I was part of the Aditya Birla Group, I took a call to follow the business partnering route for my career and as a slightly differentiated finance personality. So whereby my role has largely been around helping business to grow, drive change management, put in process and systems that helps to bring in efficiency to where businesses are there, and also ensure that the transformation process goes through and gets executed seamlessly. So I would love to do and continue to do the same in Crompton also.
Hi, sir. Morning. Good to speak to you. But you must be having some goals, right? Say with a particular time frame, maybe in the next 4 or 5 years, particular targets, maybe on the profitability front, maybe on scaling up revenues, or maybe the market share as well. Run us through some of those goals that you have put forth.
Yeah, I'm just 5 days into the system. It's too early to put in targets on the table. Having said that, if you look at the journey of Crompton, a lot of actions have been and activities have been carried out on the cost optimization, revenue maximization, which has helped it to expand its profitability over a period of time. Personally, I'm a person who look at how do you expand EPS and drive free cash flow generation, which end of the day creates value creation for all the stakeholders. What does that mean? It's also equally important for any Indian consumer organization to focus on growth. So when you drive growth and when you rebalance profits to profitability, it ensures that the EPS accretion happens, and end of the day that generates free cash flow, thereby creates significant value for all the stakeholders. Would love to pursue the same philosophy out here also, but pretty early days. I'm understanding the organization, the culture, the ways of working, the strength the brand brings in, etc. And then we will come back to you in the future to see what are our near-term targets and long-term targets.
No, got that. Mr. Arunachalam, could you tell us any prominent, significant differences that you see business-wise? I mean, the nature of the business between, from a financial perspective, between Eicher versus Crompton, and you know, in your role, how would your role and how your approach to these things will change because of this?
Yeah. See, to start with, both are great organizations, and they are market leaders in the respective categories that they play in. So it's fantastic. When the stint was in Eicher, it was really fabulous, and I see no different in Crompton also. From a Crompton perspective, it's slightly an expanded role. It's a finance plus role. That's what I would like to call it out. So it also includes strategy as part of the entire operations that I handle, apart from the routine finance role that you do. So that's one thing that gets added. Plus, I do see between the current categories and a lot of new categories that would be coming in Crompton in future, there is quite a bit to do in driving growth and driving the earnings potential. I also see we just completed the Butterfly acquisition, so there is a lot to do in terms of integrating both these businesses and ensuring that the value unlock that we were expecting gets executed on the ground. So overall, two great organizations, I think both Eicher and Crompton. It's just that in Crompton, I have a few additional responsibilities to take along with my finance role, plus a lot to focus on the integration on hand and the new categories that would be coming out in future to drive growth.
Since you mentioned Aisha being a great organization, I just have to ask you what's happening there, right? I mean, there's been multiple resignations, including yours, about 4 or 5 resignations in less than 2 years. And you were, managing a lot at the Royal Enfield end as well. Is that a bit of a concern? I mean, we haven't seen this kind of slew of resignations in such a large organization in a long time. Your thoughts?
Maybe I think it's unfair for me to comment after I have moved in from one organization to another organization. Having said that, eventually organizations are built on robust systems, processes, and eventually it is run by visionary promoters and professionals. People do come and go. End of the day, the organization continues to run in, and the brand is fantastic, the product portfolio is fantastic, and it is poised for a great run from here also. So it's unfair for me to comment at this juncture about what happened in Aisha.
All right. In Aisha, I would be one of your top clients, actually. I love the Royal Enfield. I've only ridden that bike all my life. So let's focus on this company then. From a consumer as well as from a shareholder perspective, you would have reached out to your team. How are demand trends shaping up? Any kind of sign of festive demand for Crompton Greaves? And also, if you could give us a sense about any kind of price hikes that would have been taken, say, in this quarter. You would have touched base with the team. So broad feedback on that front.
Yeah, so a large part of the price hikes that we had to carry out has already been executed. There is nothing much which is significant in nature that needs to be carried out from a price point perspective right now. What we also see is on the supply chain side, the commodity cost, which went through a super cycle, probably is getting into a phase of stability right now. So we would see that giving a little bit of comfort in terms of how does things move forward on the commodity cost. And overall, from a festive perspective, the demand has just started. We're getting into the festive season. The early signs are quite encouraging. We need to watch out how the entire month of October pans out, where we have 2 large festivals, both the Dussehra and Diwali, panning out in the same month, which will give a good indication of how things hold in.
Okay, well, Nigel would have been your biggest client or, popular clients at Royal Enfield. But
Still.
in Crompton, in Crompton, perhaps I am because of kitchen appliances and the fans, right? But no, jokes apart. Can you tell us a little bit about whether you can sustain this kind of growth? Because you said the demand is picking up in a big way, festive demand is kicking in. In Q1, your numbers were very strong. Of course, it comes on the back of a lower base. You saw revenue growth of 80%. What kind of sustainable growth rate can we expect over the next few quarters?
See, it's too early again for me to look at the long-term strategy or a medium-term strategy as to how does the growth pan out. The way I would like to call out is, one, the base business demand seems to be coming back as we are heading into the festive season. Butterfly, which has come into the portfolio, has started adding to the overall growth strategy that we have. And as we combine the organizations, there are synergies that can come in terms of revenue via the product optimization, the network optimization, and the dealer optimization that we have. Plus, there are opportunities that comes on the cost side also. There are manufacturing synergies and operating cost leverage that we can look at. This integration is also going to be critical as we drive the growth synergies for future. So we are working on a robust plan to ensure that that gets delivered.
All right. Thank you very much for joining us and running us through all of that. So appreciate you joining in, and good luck. As you said, it's just been a week since you were into the system at Crompton, and you got your work cut out for you. As you said, you want to drive earnings growth, which has been around that 10-12% mark for a while. Margins have been under pressure in Q1, not just for Crompton, but for the entire consumer durables space. Good luck with all of that. Thank you very much, and speak to you soon again. We'll take a very quick break here. The market, by the way, is still down 150 odd points, 17,916. The story is not how much we are down, but how much we are up by from the day's low. And it's a big green candle, which means that, we are up significantly from the opening levels. Let's see if, we can build on this, so there is another leg down, which perhaps materializes at some point in the day. It usually happens on very large down days, and the market picks up right at the word go, as it has now. Maybe there is, another leg down at some point. The counter to that, of course, is the very chunky, large, near 2,000 crores in FI flows that we've been getting. And if that is basically helping support stocks through the course of the day, it's going to be interesting. We'll take a quick break here. Kavinder Singh of Mahindra Holidays will join us to discuss their business outlook, how our occupancy is doing, and how's the business momentum. We'll also connect with Tushar Kevadia of IRB Infrastructure to talk about their strong toll collections as well as the business outlook going forward. Stay tuned. Back in just a bit.